Question 1. Annuity replacement and exchange rules. John has a deferred annuity with a significant cash value and is considering a 1035 exchange to a new annuity product that offers more favorable terms. Which of the following statements best describes the tax implications of completing a 1035 exchange? A 1035 exchange is tax-free, allowing John to transfer his funds without immediate tax consequences if all conditions are met. B. A 1035 exchange will trigger income tax on any gains within John's annuity upon transfer. C. A 1035 exchange defers taxes on gains but requires John to pay a penalty fee for early withdrawal. D. A 1035 exchange avoids taxes only if the annuity is transferred to a new policy within the same insurance company. Answer A. Explanation. Under Section 1035 of the Internal Revenue Code, a 1035 exchange allows the tax-free transfer of funds from one annuity to another, provided the funds remain within an annuity framework and other conditions are met. This allows clients to upgrade annuities without triggering taxes on gains. Option B is incorrect because a properly executed 1035 exchange does not result in immediate taxation on gains. Option C is incorrect as there is no penalty for early withdrawal in a 1035 exchange as long as funds are transferred directly. Option D is also incorrect because the new annuity can be with a different insurer as long as it meets IRS requirements for a 1035 exchange. Question 2. Annuity payout options. If Susan selects a life with period certain annuity payout option, which of the following best describes the benefits she will receive? A. Payments will continue only for Susan's lifetime, ending upon her death. B. Susan will receive payments for her lifetime, but if she dies within a specified period, her beneficiary will receive payments for the remainder of that period. C. Payments will be distributed for a fixed period, regardless of Susan's survival, with no further payments after the term ends. D. Susan's payments will be fixed but decrease over time based on a predetermined schedule. Answer B. Explanation. A life with period certain payout option guarantees payments for the annuitant's lifetime, and if the annuitant dies within a predetermined period, such as 10 or 20 years, payments will continue to the beneficiary until the end of the period. Option is incorrect as it describes a life-only option. Option C is incorrect because it represents a fixed period payout with no lifetime guarantee. Option D is not applicable to annuity payout structures, as annuity payments under a life with period certain do not decrease based on schedule but are fixed for the annuitant's life and the guaranteed period. Question 3. Scenario-based. Consumer protections and rights in annuities. Mr. Davis, a retiree, recently purchased an indexed annuity from a licensed agent in Georgia. After reviewing the contract, he realizes he does not fully understand the annuity's indexing features and wishes to cancel the contract. Under Georgia's consumer protection laws, what is Mr. Davis entitled to do if he acts within the allowable period? A. Mr. Davis can cancel the contract during the free look period and receive a full refund without penalties. B. Mr. Davis can only cancel the contract if he provides proof that he was misled by the agent. C. Mr. Davis must retain the annuity for a minimum of 1 year before cancelling, but may receive a partial refund. D. Mr. Davis can cancel the contract only by paying a surrender charge, regardless of how soon he acts after purchase. Answer A. Explanation. Under Georgia law, annuity purchasers are typically granted a free look period, allowing them to review and cancel the contract within a specified time, often ranging from 10 to 30 days. During this period, the policyholder can receive a full refund of any initial payments made without penalties or charges. Option B is incorrect as the free look period does not require proof of agent misconduct for cancellation. Option C is incorrect because there is no minimum 1 year holding requirement, and option D is incorrect as surrender charges do not apply during the free look period, enabling a penalty-free refund. Question 4. Types of annuities. Fixed versus variable annuities. Which of the following is a primary difference between fixed annuities and variable annuities? A. Fixed annuities provide guaranteed interest rates, while variable annuities have fluctuating returns based on underlying investments. B. Fixed annuities carry higher investment risk than variable annuities. C. Variable annuities guarantee a fixed payout, whereas fixed annuities offer flexible payment options based on market performance. D. Both fixed and variable annuities offer identical guarantees on principal and interest. Answer A. Explanation: a fixed annuity provides a guaranteed interest rate, making it stable and predictable, whereas a variable annuity's returns depend on the performance of investment sub-accounts chosen by the policyholder. Option B is incorrect because fixed annuities have lower risk while variable annuities carry higher market risk. Option C is incorrect as variable annuities do not guarantee a fixed payout. Payouts can vary based on investment performance. Option D is also incorrect because fixed annuities provide principal and interest guarantees while variable annuities do not guarantee principal or returns. Question 5. Annuity payout options. Lump sum versus structured payouts. Which payout option is typically more favorable for a retiree who wants to ensure they have a steady income stream for the remainder of their life? A. Lump sum distribution. B. Life only income option. C. Period certain annuity. D. Fixed period option. Answer: B. Explanation: the life only income option provides payments for the retiree's entire life, ensuring income for as long as they live. This option is beneficial for retirees concerned about longevity risk. Option A lump sum distribution offers no ongoing income stream. Option C provides payments for a specified period only, and payments stop even if the retiree is still alive. Option D also limits payouts to a fixed term without guaranteeing lifetime income. Question 6. Suitability and ethical sales practices. When recommending an annuity to a client, what is the most important factor an agent should consider to determine the suitability of the product? A. The agent's commission on the sale. B. The client's age and health status only. C. The client's financial objectives, risk tolerance, and income needs. D. The agent's preference for a specific annuity type. Answer: C. Explanation. To ensure suitability, an agent must consider the client's financial goals, risk tolerance, and need for income, aligning the annuity's features with these factors. Option A is incorrect as ethical practices require prioritizing the client's needs over commission. Option B is too narrow as suitability also requires analyzing income needs and risk tolerance. Option D is irrelevant as the agent's preferences should not influence the recommendation. Question 7. Scenario-based market conduct and compliance. MS Thompson, who is 60 years old, has recently retired and has $200,000 in savings. Her agent, aware of her desire for a safe investment with steady income, suggests replacing her existing fixed annuity with a variable annuity offering higher potential returns. What should the agent consider before recommending this replacement? A. Only the agent's potential commission on the new annuity. B. MS Thompson's risk tolerance and suitability for a product with market risk. C. The ability to offer a signing bonus for switching products. D. MS Thompson's current contract benefits regardless of her financial goals. Answer: B. Explanation. The agent must evaluate MS Thompson's risk tolerance, financial goals, and suitability for a variable annuity which exposes her to market risk. This helps ensure the recommendation aligns with her low-risk preference and need for steady income. Option A is incorrect as commission should not influence suitability. Option C is irrelevant because bonuses cannot override client suitability. Option D is also incorrect as a client-focused approach considers her financial goals and risk profile. Question 8. Taxation of annuities. Early withdrawal penalties. What is the tax consequence for a policyholder under age 591 who takes an early withdrawal from a non-qualified annuity? A. No penalty is applied, but taxes on gains are required. B. A 10% penalty is assessed in addition to ordinary income taxes on the earnings portion. C. A 20% penalty is assessed only on the principal portion of the withdrawal. D. Early withdrawals are always tax-free for non-qualified annuities. Answer: B. Explanation. The IRS imposes a 10% early withdrawal penalty on gains for policyholders under age 591 who withdraw from non-qualified annuities. These withdrawals are also subject to ordinary income tax on earnings. Option A is incorrect as there is a penalty. Option C misstates the penalty amount and its application only to gains, not principal. Option D is incorrect as non-qualified annuities are taxable upon distribution. Question 9. Risk management in annuities. Liquidity risk. Why might a deferred annuity be considered less suitable for a client who needs frequent access to their funds? A. Deferred annuities offer no guaranteed returns, making them too risky. B. Withdrawals from deferred annuities are subject to surrender charges if taken early. C. Deferred annuities allow unlimited free withdrawals but impose tax penalties. D. Deferred annuities convert to immediate annuities within a year, making liquidity irrelevant. Answer: B. Explanation. Deferred annuities typically impose surrender charges on withdrawals taken before a specified period ends, limiting liquidity and making them less suitable for clients needing frequent access to funds. Option A is incorrect, as some deferred annuities do offer guarantees. Option C is incorrect, as deferred annuities limit free withdrawals and taxes apply to gains. Option D is inaccurate. Deferred annuities do not automatically convert to immediate annuities within a year. Question 10. Types of annuities. Indexed annuities. Which of the following is true about indexed annuities? A. Indexed annuities guarantee returns equal to the index performance with no caps. B. Indexed annuities returns are tied to a market index, often with participation rates, caps, or floors. C. Indexed annuities are completely risk-free with no possibility of loss. D. Indexed annuities require direct investment in stock market indices. Answer. B. Explanation. Indexed annuities are tied to a market index and often use participation rates, caps, or floors to determine credited interest. This setup allows limited market exposure while protecting against losses, but with restricted upside potential. Option is incorrect, as caps may limit returns, and option C is incorrect because indexed annuities may have fees or limitations that affect returns, even though they are generally safer than direct market investments. Option D is also incorrect because indexed annuities do not involve direct stock index investments. Question 11. Immediate versus deferred annuities. Which of the following statements best describes a deferred annuity? A. It begins providing income payments immediately after the initial premium is paid. B. Accumulates funds over a period and provides income payments at a future date. C. It does not accumulate interest but offers guaranteed income for life. D. It has higher withdrawal fees than immediate annuities, regardless of timing. Answer. B. Explanation. A deferred annuity accumulates funds over time and starts paying out at a future date chosen by the annuitant, making it suitable for retirement planning. Option A describes an immediate annuity. Option C is incorrect because deferred annuities do accumulate interest. Option D is incorrect, as withdrawal fees vary depending on the specific annuity contract and timing. Question 12. Suitability of annuities for different clients. For which of the following clients would a variable annuity likely be the least suitable? A. A young investor seeking long-term growth and willing to accept risk. B. A retiree with low risk tolerance and a need for predictable income. C. An individual interested in diversifying retirement investments with market exposure. D. A middle-aged investor with a high risk tolerance and a long investment horizon. Answer. B. Explanation. Variable annuities carry market risk and can result in fluctuating income, making them unsuitable for a retiree who prioritizes low risk and predictable income. Options A, C, and D are more compatible with the characteristics of a variable annuity. Question 13. Taxation. Non-qualified annuities. Which of the following correctly describes the tax treatment of withdrawals from a non-qualified annuity? A. All withdrawals are tax-free regardless of age. B. Withdrawals are taxed on a first-in, first-out FIFO basis. C. Earnings are taxed as ordinary income while the principal is tax-free. D. The entire withdrawal amount is taxed as capital gains. Answer. C. Explanation. For non-qualified annuities, earnings are taxed as ordinary income, while the principal, the initial investment, is withdrawn tax-free. Option A is incorrect, as withdrawals are not tax-free. Option B is incorrect because non-qualified annuities use the last-in, first-out LIFO method, taxing earnings first. Option D is also incorrect, as annuity withdrawals are not taxed as capital gains. Question 14. Liquidity in annuities. Withdrawal penalties. If a policyholder withdraws funds from a deferred annuity during the surrender period, what cost might they incur? A. An increase in future annuity payments. B. A 10% penalty fee on the entire balance. C. Surrender charges on the withdrawn amount. D. A reduction in the policy's death benefit. Answer. C. Explanation. Surrender charges are fees incurred when funds are withdrawn from a deferred annuity during the surrender period, which is a designated time frame set by the insurance company. Option A is incorrect because it does not impact future annuity payments. Option B is incorrect as the penalty fee applies to earnings only in certain cases. Option D is unrelated to withdrawal penalties. Question 15. Features of fixed indexed annuities. Which of the following best describes how a fixed indexed annuity works? A. It offers a guaranteed minimum interest rate with the potential for higher returns linked to a stock market index. B. It requires direct investments in stock market indices, exposing the principal to market risk. C. It guarantees a high fixed interest rate with no ties to market performance. D. It accumulates value only through dividends from stocks in the linked index. Answer A. Explanation. A fixed indexed annuity provides a guaranteed minimum interest rate and links potential returns to a stock market index. However, it does not involve direct investments in stocks, making option B incorrect. Option C is incorrect as returns are linked to an index, not fixed. Option D is incorrect because indexed annuities do not accrue dividends. Question 16. Benefits of annuities. Death benefits. What is the primary purpose of a death benefit in an annuity? A. To allow beneficiaries to withdraw funds without incurring any taxes. B. To provide the annuitant with a lump sum payout before they pass away. C. To protect beneficiaries by ensuring they receive at least the principal invested. D. To maximize the annuitant's payouts by reducing future income. Answer C. Explanation. The death benefit in an annuity guarantees that beneficiaries will receive at least the principal invested or a specified minimum amount if the annuitant dies before the annuity is fully paid out. Option A is incorrect as beneficiaries are typically subject to taxes. Option B is incorrect because death benefits are paid after the annuitant's death. Option D is unrelated to death benefits. Question 17. Qualified versus non-qualified annuities. Which of the following describes a qualified annuity? A. An annuity purchased with after-tax dollars and offering tax-deferred growth. B. An annuity funded with pre-tax dollars from a retirement account. C. An annuity purchased outside of a retirement plan offering tax-free growth. D. An annuity with no age restrictions on penalty-free withdrawals. Answer B. Explanation. A qualified annuity is funded with pre-tax dollars, typically as part of a retirement plan, allowing for tax-deferred growth. Option A describes a non-qualified annuity. Option C is incorrect as growth in a qualified annuity is tax-deferred, not tax-free. Option D is incorrect because qualified annuities are subject to age-based penalty rules for early withdrawals. Question 18. Taxation. 1035 exchange. What is the purpose of a 1035 exchange in relation to annuities? A. To avoid surrender charges when switching annuities. B. To exchange one annuity for another without incurring immediate tax consequences. C. To roll over an annuity into a qualified retirement account. D. To cash out an annuity with tax-free benefits. Answer B. Explanation. A 1035 exchange allows a policyholder to transfer funds from one annuity to another without immediate tax consequences, deferring tax on gains. Option A is incorrect because surrender charges may still apply. Option C is incorrect as 1035 exchanges are for similar types of products, not for qualified retirement accounts. Option D is incorrect as the purpose is tax deferral, not tax-free benefits. Question 19. Annuity riders. Long-term care. Which rider allows an annuity owner to receive additional income if they need long-term care? A. Guarantee minimum income benefit GMIB. B. Long-term care LTC rider. C. Cost of living adjustment COLA rider. D. Enhanced death benefit rider. Correct answer B. Explanation. A long-term care (LTC) rider provides additional income if the annuity owner needs long-term care, making it beneficial for those seeking protection against care-related expenses. Option A is incorrect as a GMIB provides guaranteed income, not long-term care benefits. Option C relates to inflation adjustments, and Option D enhances death benefits rather than offering long-term care coverage. Question 20. Income options. Life with period certain. Which annuity payout option ensures lifetime income for the annuitant and continues payments to a beneficiary if the annuitant dies within a certain period? A. Life only. B. Joint and survivor. C. Life with period certain. D. A lump sum. Answer C. Explanation. The life with period certain option provides income for the annuitant's lifetime and guarantees payments for a specific period to a beneficiary if the annuitant dies early. Option A is incorrect as it provides no payments after death. Option B is a joint option covering 2 lives, and Option D is a one-time payment rather than an income stream. Question 21. Annuity fees and charges. Mortality and expense risk fee. What does the mortality and expense risk fee in a variable annuity cover? A. Investment management and advisory services. B. Administrative costs and profit for the insurer. C. The risk of early death and market fluctuations. D. Costs associated with additional riders. Answer B. Explanation. The mortality and expense risk fee in a variable annuity covers administrative costs and provides the insurer with profit. It compensates for assuming mortality and expense risks. Option A is incorrect, as separate investment fees usually cover management services. Option C is incorrect because the fee does not cover market risk specifically. Option D is incorrect, as rider costs are generally charged separately. Question 22. Surrender charges. Free withdrawal. Which of the following is typically true regarding the free withdrawal feature in an annuity? A. It allows the annuitant to withdraw any amount without penalty. B. It permits a limited, penalty-free withdrawal during the surrender period. C. It only applies after the annuitant reaches age 71. 2. D. It is available exclusively with variable annuities. Answer. B. Explanation. A free withdrawal feature in an annuity generally allows the annuitant to withdraw a limited amount without penalty each year during the surrender period, commonly up to 10% of the contract value. Options A and C are incorrect as they do not accurately reflect the conditions of this feature. Option D is incorrect because free withdrawal features are available in various types of annuities. Question 23. Risk and returns. Fixed annuities. Which of the following best describes the risk and return profile of a fixed annuity? A. High risk, high return investment. B. Low risk, guaranteed minimum return. C. Medium risk, variable returns. D. High risk, guaranteed returns based on stock performance. Answer. B. Explanation. A fixed annuity is typically low risk and provides a guaranteed minimum return, making it a stable option for conservative investors. Option A is incorrect as fixed annuities are not high risk. Option C describes a variable annuity, and option D is also inaccurate since fixed annuities are not tied to stock performance. Question 24. Annuity taxation. Required minimum distributions. At what age must individuals begin taking required minimum distribution (RMDS) from a qualified annuity, such as one held in a traditional IRA? At 59, 1, 2, B 65, C 72, D 75. Answer. C. Explanation. Qualified annuity holders, such as those in traditional eras, must start taking required minimum distribution (RMDS) by age 72. Option is the age at which early withdrawal penalties end, and options B and D are incorrect. Question 25. Annuity contract phases. Accumulation and distribution. Which phase of an annuity contract involves the accumulation of funds through contributions and interest or investment earnings? A. Distribution phase. B. Maturity phase. C. Accumulation phase. D. Withdrawal phase. Answer. C. Explanation. The accumulation phase is when the contract holder contributes funds which grow through interest or investments. Option A. The distribution phase refers to when payouts begin. Options B and D are not standard terms in the context of annuities. Question 26. Annuity riders. Inflation protection. What is the purpose of an inflation protection rider in an annuity? A. To allow penalty-free withdrawals in case of inflation. B. To increase the annuity payments based on a specified inflation index. C. To reduce fees as inflation rises. D. To increase the annuity's interest rate as inflation increases. Answer. B. Explanation. An inflation protection rider adjusts annuity payments upward based on a set inflation index, helping the annuitant maintain purchasing power. Options A, C, and D are incorrect as they do not accurately describe the function of this rider. Question 27. Variable annuities. Subaccount allocation in a variable annuity. What is a subaccount? A. A fixed income investment option. B. An account within the annuity where funds are invested in securities. C. A separate account used for immediate withdrawals. D. An account holding funds that earn a guaranteed interest rate. Answer. B. Explanation. A subaccount in a variable annuity is an investment option where funds can be allocated to securities such as mutual funds. Options A, C, and D do not accurately describe the purpose of a subaccount in a variable annuity. Question 28. Market value adjusted annuities. Which feature is unique to market value adjusted MVA annuity? A. Guaranteed lifetime payments. B. Payouts based solely on a stock market index. C. Adjustments to withdrawal values based on current interest rates. D. Fixed withdrawal values regardless of market conditions. Answer. C. Explanation. In a market value adjusted MVA Annuity withdrawal values are adjusted based on the prevailing interest rates. This feature may increase or decrease the surrender value. Options A, B, and D are incorrect as they do not relate to MVAS. Question 29. Beneficiaries and distribution options. If an annuity contract has a life-only payout option and the annuitant dies, what happens to the remaining funds? A. The remaining funds are transferred to the annuitant's beneficiary. B. The insurer retains the remaining funds. C. The remaining funds are distributed equally among all heirs. D. The annuitant's estate receives a refund of all premium payments. Answer B. Explanation. With a life-only payout option, payments stop upon the annuitant's death and any remaining funds are retained by the insurer. Option. It would only be correct if a beneficiary was named under a specific payout option. Options C and D are incorrect as they do not apply to life-only annuities. Question 30. Tax treatment of withdrawals before age 59. 1. If an individual withdraws funds from an annuity before age 59. 1. 2. What additional tax penalty may apply? A. A 20% excise tax. B. A 10% federal penalty on taxable earnings. C. No penalty applies to annuity withdrawals. D. A 5% penalty on the entire withdrawal amount. Answer B. Explanation. Withdrawals made from an annuity before age 59. 1. 2 are typically subject to 10% federal penalty on the taxable portion of the withdrawal earnings. Options A, C, and D are incorrect because they do not match the IRS penalty structure for early withdrawals from annuities.